I'm going to talk about cohort analysis and lifetime value, which are both very sort of hot terms, and both of which I've encountered throughout my career at various businesses. One thing that I've discovered, especially at Secret Escapes, is that it's actually more complicated than you've ever thought. I thought I cracked it, and then I came to Secret Escapes, and I'm like, damn, this is really hard. And there's so many subtleties to it that if you misuse it, it can be very destructive. So with great power comes great responsibility, as a wise man once said. Did that flick? Yeah. So what do they mean? And how do I avoid destroying my business by misusing them? Like I say, lifetime value and cohort analysis are sort of inextricably linked. And there's actually a bit of work to Excel for everyone to join in with as we show how it works. But what I found is that every business is either built on a cohort model or requires lifetime value calculations to produce its budgets and forecasts, and then it's connected into the marketing, so it helps you decide how much you want to spend to drive the business forward. Who am I? So I'm not going to really talk about Secret Escapes, you all know about that, but I'm going to talk about me. And I put this picture because it was like, oh, I'm awesome, I'm like a massive rocket. But actually it's more like the career. Because up here, you think you know what's going on, but actually you have no idea. You just feel like you're in control and you have no control. And I'm down here where all there is fire. And all you're trying to do is keep the rocket going at the bottom of it. What was interesting is I started my career at Capital One. And there you're acquiring credit card applications and credit card users. And you're building a 5-year NPV, net present value. So you're discounting future revenue streams backwards. And there you've got extremely complicated statisticians using risk models and econometric tools and bad debt scores to try and predict, are the users going to transact? Are they going to go bad? What are their balances going to look like? Amazingly complicated business, and that was really at the heart of what Capital One did so well. At eBay, each market grew fantastically, driving users and then driving transactions. And unpicking lifetime value was super key to make sure we're investing the right amount of money with digital marketing. So that marketing equation of how much is revenue when you're looking at cost, I was very much exposed to. I did some other stuff. ASOS was a great example of how lifetime value, there's no ASOS people in here, but it was very a nascent point for them of discovering how to use it, how to understand profitability, how to measure profitability, and how to make sure you were optimizing correctly. And I have some interesting stories from there. The Guardian didn't care about lifetime value because they're socialists. And then Secret Escapes, that is inherent in the business model, very similar to Botica. We acquire leads for X, we monetize them through their lifetime. X has to be less than Y. If it is, we win. So cohort analysis. So often if someone shows you a cohort model, it's a big ass piece of Excel. And the idea is that, the fundamental idea is that when you acquire users, their value changes over time. So how much they generate in the first month is very different to month 30. That's like the fundamental underpinning of why cohort analysis is required. So what you need to know is how many users you're going to acquire each month going forward. So you build this horizontal view of, I'm going to acquire 10 users in January, 20 in February, and then you overlay the fact that their first month is going to be very different to their 30th month. The idea is once you've done this overlay, how much money you make each month falls out of it. And I'll show you a little bit of Excel that shows how that works. That value of that user, of that cohort over time, is fundamentally lifetime value. So when you're trying to forecast it, you're saying, if I acquire 100 users in January, how much are they going to be worth in February, March, April, May? And that is the LTV calculation that people will talk about. Often, I mean, one of the biggest catch-alls is beware of averages. Averages are a dangerously attractive thing to look at, and always de-average stuff, especially around segments, because that was one thing that would definitely bite you in the bum at some point. What you find when you use cohort analysis, you get triangular spreadsheets. So I think Cian showed his cohort analysis. I think if you look into any tools like GA, there'll always be spreadsheets that are triangular with like missing data. And often you're sort of looking with your head, like, which way round is it? Is this like calendar month? Is this acquisition month? Is this number of months since the age of the user? So often you just make sure the person who built it can tell you which way round it's orientated. But I'm going to do a worked example. So often if you unpick these spreadsheets, you'll see a lot of Excel heavy lifting, offset, match, index. There's probably some finance guy showing off his formula. But But I'll work horizontally. So I forecast the LTV for my business. If I acquire a user, this is how much they're going to be worth every month for the next 12 months. So can people see at the back? £9 in month 1. They'll have a spike in month 2 of 11, going down to only £1 by their 12th month. Then I'll talk to the finance guy as a marketing guy and say, how many users are you going to acquire? So that's what we run across the top. So I'm going to acquire 23,000 users in January, 13,000 in March, and 10,000 in June.
Why is it going down?
Seasonality. That's the easiest thing to blame everything on. And then what you do is you just do multiplication. So you times this number of users by that amount of money for their first month. And then when you sum it up horizontally, so your guys you acquire in January in their first month, each will make £9, so you make 200 grand in January. Tuck, 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 all the way across. This is how much money you're going to make on the P&L. So this horizontal line is your P&L view of the world. So you expect by July you're making 300 grand. And this model has assumed I've stopped doing acquisition after June, which is why revenue decreases, because you're just relying on low, old months to power revenue into the future. Does that look familiar to people in terms of how cohort stuff they've seen? This is super simplistic. This is the danger of averages. I've just averaged the entire business forever in one vertical column. And only when this is forward-looking, like I projected a business. When you finally turn up into September and you're not making 150 grand, you're making 60 grand, this is when the world gets really hard because you need to unpick backwards why your cohort model hasn't worked. It's always worked for us, but this is one of the really real complexities around this way of modeling a business, because this is never always true. So what you find is if you ever go to talk to your FD, he will have something horrible like that lurking. And that is probably what will set all your targets and all the budgets, is if your model is a cohort-based business where you're acquiring users through marketing and they're generating revenue over time, again, potentially organically or through marketing, that underpins everything that happens. And that's pretty scary. And the other thing that's scary is that you need to know how much your customer's worth, and you need to make it come true. So the model is built up on the fact that in their first month, they're going to be worth £9. You need to make that number 9 come true. Otherwise, 6 months down the line, who cares about acquisition? No money's coming into the business. So that segues nicely onto how do you actually forecast the lifetime value. Discounting is up to you. Like if you're a big credit card business, 5 years out, you kind of want to discount back those revenue streams. So 1 year lifetime value, who cares really? This was a question I think raised, is how long is a lifetime? For us, it's all about payback period. We want to make sure, because ultimately we'll roll back to the P&L. Like how much money do we want to come into this business this year? So do we want our lifetime values to be greater than the cost of acquisition within 12 months, within 18 months? Like payback period is often what drives the conversation, not a conversation of how long is a user going to be part of our business. To actually build these models, you can go as complicated as you like. Like you can go very simplistic, like my single column Excel, or you can build in churn probabilities, risk curve, transactional frequencies. Like you acquire 100 users, 10 will be dead, 20 will never open the email. Unsubs curve will look like this. Your probability of transacting will look like this. Stack it all up, money comes out at the end. And then you go live. So you've got all these assumptions, and then you start getting data in real time as you're actually acquiring users. And you need to be able to feed back the reality into the model, because the worst thing is if you don't look back at what you've proposed. So it's quite easy to say, oh, lifetime value is 50 quid, and then awesome, chuck it aside, pile ahead, and the reality starts happening. And if you aren't unpicking that, you'll never course correct. You'll invest incorrectly in the wrong marketing channels. You won't identify there's an issue in their first month. And often what happens is people will wait for a year. They'll be like, okay, we won't make any changes to our lifetime value assumptions till a year later. Then we've got lifetime value. Like, awesome, we've got actuals. And that's pretty scary, because a year later, the world is completely different. You're acquiring a different user set. Your product's different. Macro conditions are different. It's really like using historic lifetime values is really a bit scary unless you're pretty confident all things are equal between now and then. Often you can use weighted averages. So you actually use the first months of most recent cohorts to actually build the early part of the model, and you use all your historic data to build the back end of the model. So I think very keen on people just thinking about how you actually convert the forecast into reality and then continually monitor that. So often what actually happens with it, because it's quite nice for the FD to have his cool cohort model, he's built his lifetime value equation, you've got the BI guys updating that, like what do you actually do, like how do you operationalize these two metrics? And often you're plugging it into a marketing ROI equation. So you're spending digital money to acquire users and acquire transactions. And you need to make sure that pot of money is more than how much you're spending, because otherwise your FD won't approve of that either. And often the question you'll get is, if I give you £1 million, what are you going to do with it and how much money am I going to get back? And often you need to know how your equation works to come back with a sensible answer. This is the blackboard. So eBay is quite an interesting example of this evolution of like, you think of marketing when you first launch as just users are worth £10. So how much money we make is £10 times the number of users. CPA model, you're driving user value at a CPA less than £10. It's pretty simplistic. At eBay, that's how we launched the affiliate channel. It was, we'll pay for new users and we'll pay a fixed amount for all markets. Then as that market matures and actually you want to actually start trying to drive transactions, you can start using the equation of number of users times, still using historic you will start getting historic LTVs, but maybe at a channel level, you can start differentiating, search is more valuable than display. And then you want to start including actual transactional margin, because that's real money. The challenge with this is often people can't unpick actual profit. So you'll see, revenue, like sales value in that. But that's like incomparable to marketing spend. Like it's just, they're two different numbers. And a lot of the work we did at ASOS was actually, what is profit? Like if we sell a dress for £100, how much actual money hits EBIT from that transaction? And that was a massive piece of work, surprisingly. Eventually, the business will mature, and you won't actually care about using new users to drive growth. All you'll care about is marketing spend, driving transactions, and then you'll just drop the user component of this calculation out. And finally, I often ask people, like, what's the calculation? So I've reminded people, because I've had lots of interviews with people recently who are not very good, and they don't know how to calculate ROI. But that's the way I calculate it. So I'm going to go through 4 misadventures in using these tools. One is either the lifetime values you've used to plug into the equation are just wrong or never come true, or they're used for evil. Because the challenge is that LTVs are massive numbers, like for certain businesses. Certain businesses, they're a few pounds. Certain businesses, they're 50 quid, 60 quid. And as a marketing guy, you can get more budget if you can claim LTVs are higher than they really are. Because then the profitability of your marketing channel increases. If you see LTVs 60 quid against 50 quid, happy days, channel's more profitable, I spend more money. One thing that I'm keen on is that LTV's cohort analysis lives in finance, and they own that. Marketing are responsible for making it bigger, but they don't actually calculate it, and they're accountable for it. So, like I say, there's a challenge to de-averaging, so making sure you're looking at LTVs over time and updating that model, like I mentioned. Weighting more recent data more heavily, factoring in seasonality, like getting control of the actual value of users coming through the door is super important to make sure when you're plugging into one of those equations, the numbers actually feel realistic. Double counting. So this is one I'm quite a big fan of. It's not great. So this is an interesting one where, let's say your marketing equation is each user's worth £10, and there's some transactions I drive as well, so I'll take credit for that. You take credit for the users, so their future value, and then in the future, they transact through marketing. So you're buying that transaction again. There's a little chart to show it. So you have to be really careful that your model doesn't unwind itself, that I spend £100 to acquire users today, and I factor in their LTV going forward, and then 6 months down the line, you're buying those transactions through marketing and not realizing you've already counted them in your equation 6 months ago. And it's super dangerous that you can basically, you're just using marketing to keep the business afloat, when in fact your assumptions had been that all the revenue would come through email or something organic. So what we did at eBay is effectively we were trying to subtract out. So this chart is, we've got a whole bunch of users and they've bought something via digital. And the split vertically is how old they are. So are they less than a year or more than a year? And a year is something we were using at eBay. And then this dimension is, did we acquire them? Did digital marketing acquire them? Or did they come to the site organically? So normally when a transaction happens and you attribute it to your marketing channel, you just say, awesome, you know, PPC drove that transaction. But making sure you exclude any transactions that happen to users that's still in that acquisition period, that you've counted when you've acquired them 6 months ago or 12 months ago, is really key. And there you need a data infrastructure in place to effectively decouple transactions between users you've already attributed to digital marketing ROI and users that, in theory, you're actually driving incremental sales again. So this is a point I made earlier, is like if you have a bad month, let's say last month was a bit of a downer, how do you unpick it? Like there are so many dimensions to cohort analysis that will bite you in the arse. So this, I don't know if people have seen this Facebook video, triangular heat maps and growth accounting. It's quite hard to find. I'll share the URL. It's a guy drawing on a piece of glass backwards. It's amazing. I don't know how he does it. It might be in a mirror, so then it's not amazing. But the dimensions to think about is like this month's revenue was sucky. Is there something wrong with the site overall? Is there something seasonal? Is it a specific group of cohorts underperforming over time? Did the marketing mix change 6 months ago, 12 months ago, and we acquired loads more PPC than Facebook? Are certain cohorts having an issue in their month 3 or their month 6? You know, you're not adjusting for seasonality. So if you acquire a cohort for us in January, that their first month is going to be massive versus a cohort you acquire in March. So these two first months are going to be very different, but that's just seasonality of the business. There's nothing fundamentally wrong with those two cohorts. So I will not play the video, but the way this triangular heat map model works is up here you've got age of the user, and here are the cohorts when you acquired the users. And what they're saying is that if you've got a problem horizontally, that means that fundamentally every user in their X day has an issue. Like, you know, 1 month into their lifetime, all users have a fundamental issue with their life cycle. If you have a vertical issue, that means that cohort's a bit broken. Like all those users you acquired historically, all are just a bit crap compared to other cohorts. And if you've got a diagonal issue, because this is time and this is when you acquired the users, so that's January users and that's January in time, that's January in time. Oh, sorry, that's February. That's a calendar month, a diagonal view. That means something's happened seasonally in the point of time. So you can use these sort of 3 dimensions to start unpacking why this month has gone weird, whether it's something calendar, something fundamentally in the time, or whether a certain cohort, whether it's part of the life cycle. So the other challenge is often you go out to your FD going, yeah, all this marketing stuff is super ROI positive. Like if I spend 100 quid and we're going to make 200 pounds, and you unpack it and like loads of it is lifetime value and a bit of it is transactional stuff. And he's like, but how do I impact this quarter's P&L? Like that's the question you get. It's like, how do we hit target from a revenue point of view when half your revenue you're talking about lifetime value and who knows whether that's going to come true or not? And those 2 questions I have all the time now. It's all functionally about hitting 2015 EBIT, how is marketing a lever to do this, and can we make cohort values come true? So like I say, one thing is to actually, even though finance might own cohort modeling, for marketing to be responsible and know that if I acquire a user now, I think I'm going to get X amount of money in the next 3 months. So then you can line the quarterly view of the business back to your marketing activity. The other option is, this is quite a subtle thing eBay did, which I've not seen before in any other business. So you don't care about lifetime value, you bin it. So you look at all the transactions that happened this month, and you look at how you acquired those users. and you attribute that revenue back to the channel of acquisition. So what happens is that the marketing revenue that we're claiming we're driving exactly matches the P&L. Like there's no fuzzy lifetime value stuff that people are going to forget about and you've got signed off. It has to match. But you're saying, if a user is greater than 12 months old, then my marketing channel gets it. And if they're less than 12 months old, then the channel that drove it originally will get credit. So search will get credit for a user they generated 6 months ago when they finally buy this month. So it's quite a subtle way of doing it, and it's probably better for sort of mature scale businesses for whom extracting value from the user base is more important than just purely growing it. So actually, I think I'm almost there. So it's fundamental to the business model. It's fundamental to marketing. It is the intersection of, and when it falls out, it's all about the P&L and EBIT. It's hard. You need the data in the right shape. Often, like for us, we can build out historic cohort models and revamp forecasts very quickly. You need to, where you're tracking the data on the back end or through GA to be in perfect shape. You need to understand what profit is as well. And it requires some mad Excel. And lastly, don't be this, because I'm really sure Fab got bitten in the arse on all of these things. LTVs didn't come true. Old cohorts deviated from the plan. So you assume that a cohort in their 12th month will be worth X, and it doesn't come true. And then you end up spending all your marketing buying the cohort value. So marketing just becomes a lever to keep the business afloat. You keep raising money just to keep the transactions going, and eventually it will all unwind. Equals death. That's me.
Thank you, Cian. Thank you very much. Now, at the risk of mixing my metaphors, I think if we can bottle at Emetria Cian in a box, we will succeed. That was absolutely fantastic.
Cool.
And there are not many Cians around, I can tell you. So, final speaker. Anyone have some questions for Cian? Okay, right. Who shall I start with? Elizabeth.
How would you layer all this approach with like Cian's approach? I mean, as it's a secret escape, how do you do like these kind of test programs about how to drive that second or that third, or what are the different layers of tools actually you layer on top of all this great maths and analysis?
So for us, our model works quite nicely because we use television and paid marketing to acquire a lead, and then inherent in our product, CRM, email, works fantastically. And actually, we care about the first purchase, not the second or the third, because buying holidays is infrequent, it's expensive, conversion rates are low. So for us, it's all about getting amazing, beautiful offers in front of people every morning, so they love opening our emails. The product itself allows people to fantasy shop. People open emails for years and then will buy for the first time. So it's we've got this funny sort of dynamic within our product. But for us is maximize response, keep people opening, and then as soon as you sort of detect interest, get them to buy. So we're not just focusing within CRM of maximizing revenue, we're trying to maximize response as well.
Questions?
You may have kind of answered it here, and it may not apply to Secret Escapes because you're such an email-driven business,
sure.
But the lifetime value can go a bit pear-shaped if you end up spending a lot to reacquire your existing customers. And I just wondered if you had any advice about how to factor that in, because quite clearly if everybody clicks on your pay-per-click advert to purchase a second time, then all of your calculations have gone a bit pear-shaped. Any advice on that?
I mean, that is sort of the buying the lifetime value thing. And then there, it's all making sure you're tracking your data is in place. Because unless you spot it, you won't realize it. You'll just say marketing is very profitable, it's driving all these sales, when in fact it's cannibalizing stuff you thought would be organic. There, it's all about getting permission marketing from that person via email or whatever mechanism, so you can actually get them organically to come to the site. Because you want people to come direct or via email. That's good. You acquire them, pay for them to come in, and ideally, forevermore, they are super loyal, type in the URL or open every email. That reality often doesn't come true, and if that assumption ends up being you pay for them to acquire them, and you pay for them forevermore to come back to your website, which Google wants us to do, and Criteo do, I'm sure most ad tech vendors would want to charge a toll for being on the internet, it can definitely be a problem.
Actually, related to that question, in any of your work previously, have you got involved in attribution modeling and kind of doing that in quite a lot of depth? And what's your view on that? Because that potentially
it's fundamentally linked.
Complex, or it can solve some of this stuff.
Somewhere there's an equation which ultimately relies on attribution, because you're saying marketing drove these transactions. So that bit of rule set is attribution. And it's so complicated. It was almost intractable. You can't actually solve it perfectly, because there's no causality in any of the models out there. So you can't tell whether not showing the ad would have reduced the probability of that event happening. There's a lot of very hardcore statistical stuff out there which you can write yourself. I'm going to say words, I don't know what they mean. Hidden Markov models, you probably know what they mean. And so naive Bayes stuff. But that is so complex, it's unoperational. You get the answer, what do I do with this now? I still have a system that is last click. I quite like using lift tests, so controlled experimental design at a vendor level. So Criteo, Facebook will all expose a certain set of the users to the ad and the other half not to the ad, and the difference is incrementality. So that's kind of the best we can get. I don't think there is any vendor has a silver bullet for this.
Okay. Well, one more question over there.
Hi there. How do you go about determining when people are lapsing on a cohort sheet, and how would you go about reactivating those people?
So it depends how granular you build. So often cohort models just are outputting revenue. The layer below that is that you are building a cohort model about response and engagement of that audience, because that lifetime value I built on the side hides so many averages, because I'm saying that an average group of 1,000 users are worth £9 in their first month, and that's hiding never active unsub rates, transactional velocity. You're hiding a lot of stuff behind that. So you almost want two layers. One that says for 1,000 users, this is how much money falls out, and for the same 1,000 users, what's their actual customer behavior to actually drive that, to make that happen. The FD only cares about the money one. So.
One more over there.
Right. I was just wondering if you wanted to test some sort of new email campaigns, some marketing campaigns, to see if you can increase engagement and value, at certain stages along the life cycle.
Yeah.
If you do that, how would you go about sort of, knowing if okay, I'm doing a test on this cohort, how has this made a difference, and should I roll this out to all new cohorts as well?
So just our experimental hypothesis, build out a control group of adequate size. There's quite a lot of sample size calculators out there. Decide how risky the test is and adjust your, how long it takes to run the test versus how much risk you're taking at two sort of dimensions, because then it defines a split in the A/B test. So if it's quite risky, 10%, leave it running for a while. Make sure you can unpack the impact at the cohort level, not just at the user level. And then some sort of stats, 95% confidence intervals. Nothing's perfect, but as long as you feel like once you roll it out, there's a material difference to the business. Because often most A/B test results look awesome. You roll them out and nothing happens. So often I only care about big impacts that when you've rolled them out, you can actually see an uptick in trade.